I'm joined by a terrific panel this afternoon, and I think you've read their bios. I'm not going to introduce them. I've asked instead that they each self-introduce themselves by answering a question. I'm going to ask Courtney to go first, and then Preeti, and then Doug. And the question is very simply, why is ESG important to you and your firm? Courtney.
Absolutely. Great to be here. Columbia Business School class of 2017, so always great to be back. I would say ESG is really important to me personally. It's frankly the reason I came to Columbia Business School was to break into sustainable impact investing. So it's personally been a career journey of mine, hopefully many of you as well. And then for our firms, I would say the really short answer is it's because it's important to our clients. We serve a mix of individual investors, institutional investors, large governments, and corporates all accessing the capital markets. And increasingly sustainability, ESG, we'll get into some of the distinctions on this panel, but all of that's really important to our clients seeking to mitigate risk, invest with fiduciary responsibilities in line with their values. So all of these things are really important to clients, and therefore it's important to us as we help manage through the capital markets on their behalf.
Thank you, Courtney. Preeti.
Hey everyone, Preeti Bhattachari, also a business school alum, class of 2014, also a Columbia College alum, class of 2009. Thrilled to be here, thrilled to be back, first time in the new space, it's beautiful. I joined the space, and I think similarly the firm has joined the space, because we are, as you know, at the very beginning of the biggest intergenerational wealth transfer in human history. That's something we know, but that's something I re-internalize every day when I go to work. And the owners of tomorrow do not look or sound like the owners of yesterday. And the things they ask for, the things they want, the things they need, the things, frankly, you ask for and want and need in the conversations have completely shifted. And we're just at the beginning of that. And so I think this whole body of work around ESG and sustainable investing is stepping into what is a fundamental generational transition. And I think that's relevant for the firm, and frankly, personally, I find that wildly exciting.
Thank you, Preeti. Doug.
And good afternoon, I'm Doug Beal. Also went to Columbia Business School, class of 1995. And unlike Courtney, I don't think there was a sustainable investing option here at the time. And so I actually had a relatively long career doing consulting to financial institutions and governments and things before sustainability was really a thing. And one of the roles I had at BCG, I was the global head of our economic development practice, and we advised governments on economic development strategies before the sustainable development goals were even created. But I decided to switch to the role I'm in now because probably about 5, 6, 7, 8 years ago, our clients started taking this more seriously, whether they be big banks, big corporations. And a lot of that is because they recognize both the impact that they can have and the business value that can be created through better sustainability and better social impact. And so that's what I have been doing since. So thanks, Bruce, for the invitation.
Thank you, Doug, and thanks to all three of you for joining us today. So the format we have until 3 o'clock is I am going to ask some questions of the panelists, and we'll talk that way for about 30 minutes, and then open it up to all of you. I believe we have mic runners, and really welcome audience questions for the remaining 20 minutes or so. So I'm going to open up with a question that's probably one that many of you are thinking about these days if you're familiar with ESG, which is the many controversies that are swirling around the sector. I see some heads nodding already. And the controversies are challenging for those in the sector because they're coming from everywhere. There are those who are criticizing ESG because it's trying too hard to improve the environment in society, and those who are criticizing ESG because it's not trying hard enough to improve the environment in society, and we can just go from there, and it's getting a bit hot out there. So Preeti, maybe you could start your perspective on these controversies and thoughts of where we are in this moment in time.
Yeah, happy to jump in, and I'll be candid. I mean, I think it's an important conversation to have, particularly with students. I think ESG, when done well, isn't remotely about politics on either side of the aisle. It's about financial materiality. And as a fiduciary, I was trained up in this school in value investing. Like, it is your fiduciary duty to know what's knowable about your investees and then to parse what you think is financially material and make allocation decisions accordingly. ESG is just another tool in the toolkit to do that and to bring environmental, social, and governance considerations into your analysis that others in the market might be overlooking. And so if you have an opportunity, Bruce Greenwald, again, one of the legends of value investing, always said, every time you make a trade, there's a person on the other side of that trade, and one of you is wrong. So how do you make sure that you're the one who's right? What informational analysis or asymmetry are you bringing to the table? ESG is an opportunity to bring a lens, a data point to the table that your counterpart might not have in their toolkit. And so, again, as a fiduciary, why wouldn't you do that? So to me, ESG isn't remotely about politics. It is all about being a better investor and using more tools in the toolkit.
Well put. Doug, what are your thoughts on this?
I agree 100% with Preeti. I mean, it's about creating more value. It was remarkable that, I guess the state of Florida was one of the states that, please don't integrate climate into your investing decisions. And then a hurricane comes through and wipes out, a lot of houses, right? Just really, really amazing. But the tricky part about sustainable investing and ESG integration, as my colleagues know, is that it is so complicated and there are so many different ways of doing it, whether you're doing negative exclusions or real ESG integration or best in class. And part of that is to create value. Part of it might be because your clients have certain values that they want you to integrate into your investment process, which is fine, right? That's fine. But what the politician sees upon is the most basic, usually like the negative exclusion type questions. And the issue is that when it gets written about by most of the correspondents out there, it's too complicated to be able to describe in the 800 words they have, so it gets overly simplified. And so I'm constantly frustrated when I'm reading, whether it's the Wall Street Journal or The Economist or anybody when they're talking about this, because you can only scratch the surface in a fair way. And I think that serves the politicians probably well, unfortunately.
Courtney, anything you want to add on this topic?
Yeah, I would just add, the political dynamic is certainly one that we have to pay attention to, again, as a firm that's in this space, that's making commitments. But I would say what's really important to us is staying incredibly focused on the commitments we have made around sustainable financing targets, around net zero financed emissions, our own operational carbon neutrality. These are key commitments we've made and we're sticking to, and also remaining very focused on our clients. Again, whether they're coming for a strictly fiduciary perspective or they're coming from a values-based perspective. I think it's really knowing your client, which isn't frankly new when you think about investing, and really integrating their goals into the outcomes that you're seeking to achieve. And so I think if this is always rooted in objectives for clients, I think that is really key.
What's fascinating about this controversy is it seems totally upside down. I mean, it's being criticized for trying too hard on the environment and social factors, when in fact, to Preeti's point, it's just smarter investing. I mean, if you're going to invest in a business, you want to know all the material factors. You want to know if that business is going to suffer flooding or hurricanes or anything else. Kind of smart investing. The problem is, I'm not sure how impactful it is on actually addressing underlying issues, say like climate change. Any thoughts on that controversy, coming from the other side, which is ESG really helping us address these great challenges we face?
I'm happy to jump in there. And I think it comes back to this point around when we talk about this space, I think we as practitioners in the space have done ourselves a disservice by lumping it all together as though it's a single monolith. Really, when we're talking about sustainable investing, we're often talking about different approaches that are trying to achieve different objectives. Sometimes there's a values-based objective. Sometimes there's a financial materiality, what we call ESG objective. Sometimes there's an impact investment. And impact investing and ESG are related, but they're not the same thing. So Bruce, to your point, I think
sorry, just for the audience, what's your difference definition of impact investing versus ESG?
Yeah, impact investing is the approach we take with clients who say, I want to see a change in the world. I want to actually make sure my capital is going towards enterprises that are making the world different in some way. And ideally, I even want to know that they're using my capital above and beyond what they otherwise would have done to make that change. That term is additionality. So impact investing is where a lot of what you're describing. It's for clients who say, I want to make real change in the world. And appropriately, the threshold for impact investing is often higher. You want third-party, robust impact reporting on an ongoing basis to make sure that the companies are actually making change in the world. That is a different flavor and profile of investing than what I would call ESG, which is really a financial materiality lens, which is about identifying opportunities and often risks in a portfolio. And I think by lumping impact investing and ESG together, we often confuse the conversation when by design, those are actually different things.
Mm.
And I think the market stats are that overall sustainable investing broadest definition is 30 plus trillion. Last week, the Global Impact Investing Network just announced that impact investing has reached 1 trillion, right? So there's orders of magnitude difference. And as Preeti well described, those are related but different disciplines.
Yeah. Any thoughts on this point, Doug?
Yeah, I would say one thing to point out, and I think why ESG integration, meaning you're taking into account material factors, is that there's been lots and lots of studies done by academics, by banks, by BCG. Most of them show the corporations that perform better on financially material ESG factors have better valuation multiples and lower cost of capital, right? So there's real reasons to do this, right? And so whether you're a bank and an investor making decisions about your clients, either decision might be how you engage with them to change their behavior, or whether you're going to invest in them or not, right? Or lend to them or not. But even if you plan on, when you leave Columbia, you're going to work for a large corporation, how do you manage your corporation towards better ESG performance? And how do you factor that into the business decisions you make? How do you translate that into better ESG data and performance? And how do you communicate that to your shareholders as a way of creating value for your firm and for your shareholders?
So there's a complex area in finance. It's a controversial area in finance. Fortunately, we have some very experienced panelists in this area. So my next question is, how has ESG changed in recent years? What are the thematic changes you're seeing in this sector? What's changing now? Where do you think in the next couple of years you're going to see some of the themes become more dominant and investors show greater interest? And maybe, Courtney, you could start off there.
Sure thing. There's a whole lot of trends and change happening in the space that you might not get in just the 800-word news headlines these days. But a few things that I would say we're keeping an eye on closely in our day-to-day. One is a real growth in transparency and authenticity of ESG information. I think you're seeing that play out in the growing regulatory context that particularly is coming out of Europe, also here in the US, but also just investor demand, right? We've now seen a decade plus of credible ESG and sustainable investments, and investors are getting smarter and wanting to know more. So I think the increased transparency around both corporates and investors is really going up. That's then driving a whole host of interesting innovation around advanced ESG data and analytics, right? This has gone, ESG scores continue to be in the headlines and an important first step tool, but really the granular data and some of the emerging areas, whether that's around physical climate risk, geospatial analytics, net zero pathways, some of these really, more innovative, interesting data-driven solutions. Frankly, that's where job opportunities are going. That's where there's a lot of opportunity for investors. That's a big trend that you might not always see in the, quote, ESG headlines. And then I would say there's a lot of themes underneath that too. I would say biodiversity and natural capital are huge opportunities, hugely interlinked with climate, as well as the circular economy, waste reduction, and then inclusive finance, and particularly how that relates to the transition to a low carbon economy and doing that in a just way. So I would say those are some of the big trends and things that we see as opportunities, both for us and for our clients.
And the change in the tools are out there is really amazing. I think back a decade ago, I look back, I'm like, wow, we had no idea what we were doing back then. Still confusing as it is. Preeti, what are the themes you're seeing at the moment?
So I'll pull in a few of the same threads. I think within the environmental space, climate change continues to be a really durable theme that gets a lot of attention. But non-climate change related environmental themes include certainly biodiversity. We're seeing a lot around food and agriculture, specifically regenerative agriculture. Relatedly, we're seeing a lot around water systems. We're seeing a lot around plastic packaging and plastic pollution, especially as it relates to some of the new extended producer responsibility laws that have started to pop up at the state level throughout the country. And then we're seeing, I think, increasingly, we're just chatting about this, a shift from purely environmental lens to a social lens as well, which I think is a space that's frankly been a little bit more neglected by the sector.
And there are specific social themes that you see
absolutely.
emerging?
So within the social space, gender lens and racial equity, and particularly closing the racial wealth gap, have been recurring themes for a while. Increasingly, particularly once you get outside of New York City, people are talking about veterans-related issues, and they're talking about them a lot. So as we see growth in the space, particularly growth outside of New York and California, growth in other markets, I think some of these other social themes, particularly around veterans, are starting to emerge as a lot more prominent.
It's really interesting. It's terrific. Doug?
Yeah, I guess I would broadly agree with my colleagues here. As a consultant, we've supported banks, global banks around the world the last 2-3 years on a lot on their net zero programs, right? A lot of the global banks, of course, and asset managers and wealth managers have declared net zero. And then there's a very, very complex exercise to go through to get there. I think at least the advantage, not to oversimplify it, but the advantage in climate is there are frameworks out there. There's targets. There's there's PCAF, there's SBTI, there's goals that everyone is sort of agreed on, and many of the banks have started to set themselves down the path, right? And now the world is a bit tipsy-turvy right now. We've had COVID, we have Russia's invasion of Ukraine, which has disrupted energy supplies and food supplies. And I think there is a bit of a thinking now, all right, now I've got to think about social again, about rising inequality, about human rights, about all kinds of things. And the complex part about social is it's not just like climate where you're measuring greenhouse gas emissions. There's dozens and dozens of different social topics to keep in mind. And social tends to be very different across industry, very different across region. And so it's very complicated for a global financial institution or a global corporation to really think about what is that is important and how can I create an impact and how do I measure against that impact?
I just want to add a point to that because I think that's spot on. I think some of the most cutting-edge thinkers we're coming across in the space are exploring the intersection of environmental and social, specifically through the lens of the just transition movement. So I don't want anybody walking away from today thinking environmental and social are siloed. If anything, I think the really sophisticated analysis is probing where do those intersect. And for example, when you're looking at an investment opportunity through the lens of just transition, what does it mean from a climate standpoint? And what does it mean for the workers or the residents in that community who are therefore affected by that transition as well? Those are interrelated conversations and increasingly so.
And sophisticated. That being said, there is sometimes a pushback against that. The Economist published an article about a month ago now, I'd say, actually more than just an article, it was a whole report suggesting that ES and G should be a very separate area for S and separate to G, that when you try to do these things together, multiple objectives and less impactful. Any thoughts on that? Yet another controversy, whether or not we should be doing, as Preeti said, the most thoughtful way, which is actually seeing when these intersect, or whether these are really separate issues and require a individual focus.
Maybe I think agriculture is a great example of if you're going to optimize an agricultural system, you can't just optimize for carbon. We'd all be eating soybeans the rest of our lives. You've got to optimize for carbon, for livelihoods, for biodiversity, for nutrition, right? So especially in places, especially in emerging markets where you're thinking about a place like Brazil, what's the right set of variables and how are you going to do that? I mean, I agree with 99% of the Economist. I did not agree as much with that article. I think that I understand they were basically saying everyone should measure carbon, everything else is too complex. And I agree it's very, very complex to measure some of the other ESG topics, in particular on the social side. But it's getting better, there's more and more transparency, and I think we have to keep on it.
Just because it's hard doesn't mean we shouldn't do it. Any other thoughts on this topic?
Yeah, I would just say sustainability, whether you call it that or ESG, I think is inherently an interdisciplinary field. I think that's what attracted me to it. I think it's probably what attracts a lot of my colleagues and peers that are in the space. I think it does require deep expertise, whether that's a community activist and community engagement, whether that's a carbon markets or climate scientist, right? I think if and as you target specific outcomes and look at specific data, you need to bring the right expertise to the table. If you're taking that materiality lens, as Preeti described quite well, you need to look at all material factors, and those are going to fall across ES and G issues as you think about a company and the multiple factors that factor into performance. I think it's probably a pushback to the growth in ESG labeling and to say that there's so much being thrown under the umbrella of ESG. What is actually coming out of that? So I think there is a natural push and pull between kind of putting everything together, thinking holistically about materiality, but then when you're explicit about the underlying expertise you need or the underlying measurement that you need, or in the cases where you're achieving specific outcomes, you do need to be very laser focused on what you're trying to achieve, whether it's an environmental, a social, or a governance topic. So I think the need for domain expertise coupled with a holistic lens is going to continue to be critical. And I think the new challenges that are arising around how you measure biodiversity and nature and inclusion are really good ones. And I think as a sector, we need to be up for the challenge and take that on.
We've delved into a little bit of the complexity between these different issues and how they're connected and the complexity and the challenge that comes with that. Let's just go deep for a moment in one part of it, which is climate, because that is most prominent at the moment. And also, it's the only sector that's gotten massive government support. The Inflation Reduction Act is by far the largest bill to pass on climate change in the US, if not anywhere on the planet at the moment. And certainly when it comes to ESG, is probably the number one driver at the moment. Thoughts on the implications of the Inflation Reduction Act? It's a pretty new piece of legislation. I think it's going to be some years before we know the full impact. But from where you sit, what are your thoughts on that bill and what it means for ESG and the sector?
Yeah, I can jump in and start. I would say, this is capturing the attention of a lot of our investor clients. Our research teams are out looking at this. So it is a huge focus when we think about ESG investing. I think worth noting, it's the Inflation Reduction Act, right? In title, it's not a climate bill. That said, it is the most significant piece of climate legislation and climate policy in the U.S. That we've had. It's $370 billion of tax credits and other incentives for clean technology, climate tech, and then green finance as well. So this is fundamentally going to shift the way Americans get their energy, the way we think about U.S. climate policy going forward for decades. And that's incredibly important, both because it didn't look like that was going to happen a matter of months ago, and also because the U.S. is the second largest country emitter behind China as we think about carbon emissions. And so being able to put the U.S. back at the forefront of the conversation and taking concrete action on climate through these mechanisms, I think is hugely important. The other observation I would say, as opposed to prior climate policy and legislation, is it's really shifted the narrative for investors and businesses. It's not as much about taxation and kind of costs, but it's really about tax incentives and tax credits and loans and guarantees and access to finance in a way that it's made it very pro-business, pro-opportunity, really about the bottom line. And I think that's really opened up kind of a new flavor and a new tenor of conversation around what's possible in clean energy, climate tech, and therefore raising a lot of really interesting discussions for investors. So I think it's really exciting in the space that I sit. I think it's also, when you look into the legislation around the federal green bank and allocations to more underserved communities, I think there is that also flavor of intersection with social issues that are really important and critical to make sure that the transition to a low-carbon economy is one that is ultimately inclusive and sustainable for the long term. So those are some of the dynamics I've picked up on that policy so far.
Good. Thanks for those points. Preeti, Doug, thoughts on Inflation Reduction Act, the strangely named Inflation Reduction Act?
So I think Courtney really hit on it, especially all the tailwinds that are in the space. I think when you're unpacking the Inflation Reduction Act, I find it useful to deconstruct it into kind of three parts. So you have how it supports the supply side of the energy transition, how it supports the demand side, and how it supports the enabling infrastructure. So on the supply side, that's the renewable energy. That's going to be your wind, your solar, all of the renewable energy themes you already know and see. On the demand side, which is perhaps the side I'm most excited about, that's the subsidies for, as everybody knows, electric vehicles. You say clean transition or clean energy, everybody thinks of electric vehicles. Perhaps most excitingly, though, there's a ton of money going into retrofits, commercial and residential retrofits. So I think within a couple of years, when you walk into a room and you say energy transition, people won't necessarily think electric vehicle, they'll think heat pump, they'll think insulation, they'll think thermal envelope. These are all markets that are getting a huge boost. If you look up heat pump sales over the last couple of weeks, they've spiked already. It's a really interesting moment to be in both residential and commercial retrofit space. And then the enabling infrastructure, you can't forget that either. It's wonky, but this is Columbia Business School, so it's probably full of wonks. Like, dig deep into what's happening in the enabling infrastructure, the microgrids, the semiconductor space, all of that technology that you need to link the demand side and the supply side, they're getting a boost too. And I would say that's where some of the more interesting investment opportunities are right now.
Perfect. Doug, any thoughts on the IRA?
I guess, look, I'm not as much of an expert on the IRA as my colleagues here, but I know for our clients, it's really opened their eyes for what the opopportunities are. So certainly it's going to make a big change.
I would add one point to it, which just to add what was said, many of the sectors that the IRA is supporting, renewable energy, electric vehicles in particular, were already hot sectors before the stimulus. So they're going from very large, multi-$100 billion sectors, already growing at extraordinary CAGRs. And actually, we don't know the implication of the act because it's very hard to know how fast it can grow. You can't buy an electric vehicle at the moment. Long waiting lists. It's almost impossible to get panels to build solar. It's really a question of not will this accelerate, but what's the sort of limits to scaling that are out there at the moment. And there are a lot of infrastructure challenges around supply chain and the like. So speaking of government involvement, let's talk about regulations or the lack thereof. Because ESG there have been very few, if any, regulations in this area to date. The SEC has been proposing some regulations. There's some progress there in a number of different areas, both on climate emissions and on products. Let's start on the product side, and SEC thoughts, or not thoughts, but what they're working on there. And Doug, maybe back to you and your thoughts on that. We'll work our way back this way.
I'm happy to. Okay, so I think the first thing we ought to just lay out is right now, there really are no rules about the labeling of ESG funds, impact funds, sustainable funds, responsible funds in the United States, right? There's more in Europe right now, where, Europe, you may have heard of the SFDR, where you have to designate your fund in Article 8 or Article 9 or Article 6, and some countries like France have rules around labeling something sustainable. What does that mean? All right, but in the US, it's still pretty early days, which means one asset manager could label something responsible or sustainable or ESG, and you don't really know what they're doing underneath. What's the methodology that they're using to construct that fund? And wealth managers then have to sort out, okay, what does this mean and what does that mean? And how do I interpret it for our clients? So the SEC has come up with a couple of tentative recommendations, I guess, that now are going through the consultative phase on this. One of them is basically around, it's basically saying, do what you say you're doing, okay? If you say you're doing ESG integration in your prospectus, do ESG integration. And this is how DWS got in trouble, right? Because their head of sustainable investing came out and basically said we were not doing what we were saying we were doing. I am totally in favor of that one. The other one is trickier. The other one is more around labeling. And I don't know if they have the exact wording, but something around, like, if you want to label something sustainable or ESG, you have to take into account ESG factors more than you take into account financial factors. And the fact that this more or less is completely, you take into account together, right? If you've got a DCF model and you're looking at the cash flows of the company, you are integrating ESG and you're deciding how ESG is going to potentially impact that. And that may or may not change your decision whether you're going to invest in that company, right? So I think for the labeling one, they have to get more specific around sustainable, responsible, impact, ESG, and they probably need to do some de-averaging. And the other is just have a better understanding around the way a real asset manager does construct a portfolio, integrating ESG in different ways and having different kind of rules underneath each of those. It's overly simplified in my book right now.
Thank you for the introduction. Any thoughts on the regulatory side, SEC or otherwise, from where you sit on the asset management side, how you see this coming, how you'd like to see it structured, how important is it to you? Preeti?
I'm happy to jump in. So as usual, I go back to fundamentals. When balance sheets and income statements didn't fall from the sky. We had to sit down and standardize them. And by the way, that only happened about 100 years ago. So this debate about EBIT versus EBITDA and how to calculate it, those are all debates that happen in the traditional finance side as well. We're in that moment for sustainable investing as well. And so this is a natural evolution of the space. Standardization, regulation, these are natural evolutions for any space as it gets professionalized and scaled. And so I welcome that. I think it's really important to see increased standardization. I think there's going to be healthy debate about what the metric should be, because no metric is sacred, again, on the sustainable side or on the traditional financial side. And we're going to get it wrong before we get it right. And that's part of the learning process and making sure we're open about that and understand that we're all going to pick a bunch of KPIs and they probably won't be right at the beginning. And then we're going to keep getting better. And that's our commitment, just like it was our commitment on the original financial side. But back to your earlier point, the fact that it's hard doesn't mean that we can get away without doing it. And so in terms of the effort for regulation to come in and also self-regulatory groups to come in and start talking about what are the KPIs we should be standardizing around, wildly supportive of the initiative. I expect it to get messy, and that's kind of the point.
Yeah, I think it's important to remember it's taken us a century to come up with financial regulations and accounting rules, and they're still not great, right? We still are challenged by that issue, let alone this one, more complex one. Thoughts from your side, Courtney?
Yeah, look, I think the seat that I sit in at Morgan Stanley is a team we call Global Sustainable Finance. So we really do operate globally. And I think the perspective on regulation is particularly interesting as you look not just at what the US is putting out, but the details, as Doug pointed to, in Europe. We're seeing more evolving in Asia as well. So I think there's going to continue to be a proliferation of of regulations that aren't going to quite line up. And so operating as a global firm, not just Morgan Stanley and our peers, but many global firms, right, are going to be subject to a lot of these. And so again, maybe from the student seat, there's going to be continued job opportunities, right? There's going to be more reporting requirements and more work to be done. And so I think there's, a regulatory lens you could take to this, which is, we need to check the box. But I think as we've done from a reporting perspective, we've used voluntary standards like the Sustainability Accounting Standards Board or SASB. Those tools, you could view them as a check the box, but they've actually helped really focus our efforts on what's material and what's important. So my hope is that even in the proliferation of regulations that we see globally and the work that's going to need to be done and that's underway, it can also be a tool for aligning outcomes, resources, and focus on some of these areas.
So I'm going to ask one more question and then open up to the audience. So please think about questions you have for our panel here, which is just following on the discussion we just had about regulation, specifically the SEC regulation. Of course, today, particularly here in the US, we don't really have regulations yet. And there's certainly some discussion and concern around greenwashing or mislabeling the sector. We started the panel with all the controversies going on and misunderstanding about what ESG is and confusing with impact investing, and there seems to be just a compounding of potential for misunderstandings, mislabelings, and ultimately greenwashing. So how serious is this issue? And what should we be doing about it? Is the solution we need regulations and that takes care of it? Is it more of, as an industry, we can address this? What do we do about that issue? Who wants to start us off?
I'm happy to jump in. I'm always keen to talk about greenwashing. I think it's important. Greenwashing is an issue. It's absolutely an issue in the space. I think it's an issue, back to the need for standardization. It's an issue we should all take seriously. I think the only real antidote to greenwashing is robust, ongoing reporting. In part because a lot of greenwashing, once you actually dig into the greenwashing stories, a lot of the greenwashing stories aren't about what happened in the pre-diligence, pre-investment period. Once the investment was made, it was the fact that the investment was just allowed to run its course without ongoing monitoring. And that's a huge issue. I think as a space, we're getting much more sophisticated around focusing not just on pre-investment diligence, which is incredibly important. You need robust manager selection and due diligence with sustainability at its core, pre-investment. You also need it post-investment. Post-investment monitoring, again, back to fundamentals. Post-investment stewardship and monitoring and management needs to be a core part of the space as well. And so having thoughtful, ongoing impact reporting, ESG-related reporting, that's the only way to actually strip out greenwashing on an ongoing basis. In that vein, we acquired a data analytics company at the end of last year called Open Invest in order to help us think about how to do that across our platform of 145 managers. How do we pipe in data on a regular basis to make sure that companies aren't just, managers aren't just claiming during the due diligence process that they're going to do something, that they're actually doing it on an ongoing basis. The last thing I'll flag about greenwashing, which is bizarre, is when I was sitting where you were sitting in Uris Hall 10 years ago, companies weren't bothering to greenwash. Greenwashing wasn't really a thing. The whole idea behind greenwashing, bizarrely, is the equivalent of companies now crashing the party. I remember when nobody wanted to come to the party. The party was like us sitting in a room twiddling our thumbs. And so, in a strange way, greenwashing itself is a signal of how popular ESG has gotten, that companies now even feel the need to greenwash, which doesn't mean greenwashing is a good thing, but I take it as a signal of scale and maturation of the market. And this, in many ways, is the uncomfortable adolescence of the market that we're going to need to work through. And the only way we work through it is with robust impact reporting on an ongoing basis.
I love that analogy to crashing the party. And kind of like my classes, they were a lot smaller 10 years ago. Now they're more popular. Just want to ask one question. I completely agree about the importance of reporting. The question is voluntary reporting going to get us there, or do we need regulatory reporting? Because if we think back to your example, Preeti, about financial reporting, at one time there was voluntary financial reporting. There were no standards. There was no 10K, 10Q. You just told people whatever you wanted in terms of your financials, and that didn't work out too well. That's where we are right now on sustainability metrics. Do you think we have to have compliance reporting?
So what is good financial reporting? It is historical, it is auditable, and it is comparable against peers. Good sustainability reporting needs to be the same. It needs to be historical. It's not just promise and pledges. I will confess my patience is wearing thin for all the companies making promises and pledges. That's all well and good, but let's take a look at what you've actually done historically. So historical, auditable. Are you willing and able to bring in third-party entities to verify it? And then comparable against peers. Are you not just picking and choosing whatever KPIs you think make you look cute? Are you actually picking KPIs that make it easier for us as investors to analyze you against peers? As long as impact reporting is all three of those, I personally feel less strongly about whether it's regulated or self-regulated, but I want to see impact reporting that meets those same standards of financial reporting: historical, auditable, comparable against peers.
Thoughts on this issue?
Yeah, I think the only risk that I see in kind of top-down regulations is kind of the proliferation of KPIs that may not be material, right? So I think the built for purpose imperative for all this reporting is really key. I think that's one of the reasons why, in the absence of regulations, we've again adopted standards like SASB, or in the case of climate, TCFD as a reporting mechanism, because it's adopted by the industry. It can be compared against our peers, right? Those are more frameworks, not necessarily all KPI driven. So I do think some amount of standardization regulation, whatever form it takes, is going to be helpful for investors, but I think it needs to be done with the right level of focus and not just throwing out, okay, here's the 10 metrics that everyone needs to report, because, by the way, those aren't going to make sense for all companies and all sectors. So I think it's a mix of that context and the quantified metrics. So I think it'll be really interesting to see how that plays out. And in the absence of that, I think the evolution of market standards, right? Sorry, last point I think is, there were industry-built standards like SASB. Those have now rolled in, right? There's a lot of M&A in this acronym space with the Values Reporting Foundation and now the ISSB. If you follow that space and know all those acronyms, it's great. I think it's laying the foundation for a more robust and built-for-purpose regulatory environment, which I think is really important.
If you don't like acronyms, this is not the sector for you. Doug, less thoughts
Yeah, just
on this?
final, greenwashing can happen at different points in the chain. A company can greenwash, and then it's up to the asset manager to figure out if that's what's happening there. But also an asset manager can greenwash, right? And then it's sort of up to the asset owner or the wealth manager to decide. And as long as the asset manager isn't lying about what they're doing, then you could label something a green fund. It's up then to the buyer. The question is the buyer sophisticated enough to actually look into the prospectus, understand the process they used to integrate climate into their investment process or not? Sometimes it's pretty flimsy, to be honest, right? And I think that's where, there is more and more transparency, and asset managers and companies are getting called out on that more and more. So whether it be the regulation or just industry standards like TCFD and SASB and other types of reporting frameworks.
Those are all really thoughtful comments on a difficult subject, important subject. So let's open up to the audience. It is challenging, right? The classic example being Tesla, which is
exactly
big on the E. It's changed the entire industry. Not great on the S and really poor on the G. So I don't know, how you come out on that.
No, a colleague who was working at an asset manager was describing their fund that they had created. It did not include Tesla. It did not include some of these companies. And people would say, what? That's one of, it's because their client said, we care about human rights, and we really want you to screen for human rights very strongly. So.
I think part of what you've both done is appropriately deconstructed E, S, and G. I think there's another deconstruction that's also sometimes useful in this context. If you think about the footprint of any company, of any enterprise, even a nonprofit, there are three component parts. There are kind of three verticals. There's the supply chain, there's the core operations, and there's the product and service. And that also gets at the Tesla conversation, some of these other conversations around having a environmentally sound product and service does not mean that we're not going to ask you about your operations and your supply chain as well. The related difficult thing, I will say, as an investor is if you are screening every company for supply chain operations, product and service, environmental and social governance factors, and you're only looking for companies that have perfect scores across online boxes, your investable universe is 0 companies. And so that is the harsh reality of the world in which we currently live. And so the question becomes, again, as a practitioner, what do you do about it? Are you paralyzed and say, well, fine, whatever, I'm just going to stay invest in the S&P and give up on the whole exercise? Or do you start to actually dig into those 9 boxes and say, where is my emphasis going to be? Where is my focus going to be? And even as you think about companies, to add an additional complexity to it, companies aren't static. They're changing on you. The moment you score them across those 9 boxes, they're going to keep changing. What's that Oscar Wilde quote? Every angel has a past, every devil has a future. That applies to companies too. And so thinking about those 9 boxes in the context of momentum change, and then thinking about how they're comparable against peers, that's what really robust analysis in the space looks like. And I offer you that framework not because it'll give you a worksheet that'll find you the perfect company, but at least gives you a framework to start to think about how does this company fit into my ESG lens, my values, my investment thesis, and based on that, where do I go from here as a practitioner who has to allocate to something?
I think we have time for one more question. Can we take one more somewhere on the side? Maybe in the middle? How about instead of the side, middle? We can get a mic all the way over there.
Hi, thank you very much for joining us here. Sylvia from Class of 23. So my question to you is, we've seen how in oil and gas, a bit of a worrisome trend happening is that the more or less good companies, because they have more media presence, end up selling their assets, and who buys them is some very obscure PE firm that operates in an even less climate-focused way. So that's even almost like a step behind. Is that a risk also in the finance and investment space that because Morgan Stanley or like JPMorgan have more presence, they need to do a shift and a lot of things end up hidden in more obscure companies?
I think
Great
it's
question to end on. That's a wonderful challenge to our panelists.
Yeah, I think it's a great one, and it's actually one that I think, Bruce, you and I wrestled with on the advisory committee for socially responsible investing for Columbia's own endowment, right? As most of you may know, Columbia University has a policy now around oil and gas companies in the endowment. So that was an interesting debate that we had around where those get held. If you fully divest, then are you shifting ownership to less transparent owners, and are you actually creating a worse problem potentially than you were setting out to solve? So I say that with my former, my Columbia alumni hat. Wearing whatever hat you want to put on my head now for the rest of this, I would say it's a really good question. I think that is one of the reasons why, as a global bank for Morgan Stanley, we've made in our net zero financed emissions commitment, we were aligned on that end goal. We've set very transparent interim targets by 2030 about particularly in the energy sector as well as power and autos where we want to be. But I think we want to be a participant in the transition. We want to continue to work with, whether it's oil and gas or other companies, because we think the orderly transition is what's really critical in achieving that. And I think if you look at the data and the charts from the GFANs and other global initiatives, right, one of the biggest deltas or the biggest wedges as you look at the pathway for emissions that we need to get to globally is making dirty clean, right? That transition. It is about new technologies. It is about turning some things offline eventually, but the transition is a huge opportunity. It has to be done really credibly and really well. And ideally, you do it with transparency, which includes the public capital markets and where that transparency does exist. So there's going to be tough choices along the way there. Not all companies are operating with the same objectives and the same aspirations for transparency. But I think it's a hugely important dynamic and one that requires that lens on, as Preeti was laying out so well, right? Both the products and the operations and the supply chain. I think keeping that holistic lens on certain sectors is going to, on all sectors, but particularly some, is really key.
I think this also drives at a core debate in the space that everybody is still having and should have around if there's an asset in your portfolio that you don't like, are you better divesting from it? Or are you better holding it and engaging with it? That's like at the core of so much of your question. And the answer is it depends. It depends who you are. It depends what your capacity for engagement is. We talk to clients about this all the time where they say, which is better? And the answer is, well, if you have a family office with an entire engagement team that can work with the company on an ongoing basis to figure out what best practices are and upskill them across those best practices and check in with them to hold them accountable for those best practices and file shareholder resolutions against them if they fail to meet those best practices, great, do that. Do you have those resources? And that is true for every asset holder, that's true for every client, asking those questions around what is my role, because this is an ecosystem and everybody needs to play a role in the ecosystem. Is your role in the ecosystem to hold an asset, to divest from the asset, to try to engage with the asset, and being ruthlessly realistic about what your capacity is for all of them. And back to greenwashing, I think a lot of where you're seeing accidental greenwashing in the space is from folks who are like, I'm gonna hold and I'm gonna engage. Oh wait, I never actually found time to engage. That's a real problem in the space. Ask your managers about that. If they're telling you you're engaging, ask them the timeline for engagement, ask them the plan for escalation, ask them at what point will they divest if in fact escalation didn't work? That is an incredibly important area, and I think it's frankly something that we're just at the beginning of refining as a space to get tighter around what does good engagement look like, and in the absence of having the resources and bandwidth to do good engagement, when is divestment more appropriate? And that answer will be different for every family and for every institution.
Well, I would just add, I'm not working for a bank, but my clients are, and I think one of the things that we are doing with many of our large banking clients is helping them with some pretty sophisticated models to understand the actual behavior of their clients, because at some point they're going to need to make that decision. You know, how much do they trust that that client that they are lending to or financing is on a pathway to net zero? And you know, how long are they going to stick with that client? How legitimate is their strategy towards achieving net zero? Because ultimately for a financial institution, you're dependent on who you're lending to, who you're investing in to reach net zero. And you've got to make decisions on engage, hold, buy. It's very complicated.
It's been an excellent conversation. I think we introduced the panel by telling you how complex this field is, how controversial it is, how quickly it's changing. And I feel very honored that we've got three real experts that help us the guideposts around this and what to think about as you work through it. So please join me in thanking our panelists today.